Hello, everybody. Welcome to Your Bread and Butter podcast. I'm Ryan Cummings.
And I'm Andrew Boudry. Today we're going to be looking at how do you get paid in your last career in retirement, turning those retirement assets into reliable income and making sure it gets delivered to your bank account.
Well, speaking of income, do you know why dough is another word for money?
No, I don't.
Well, because everyone needs it.
Rise to the occasion.
Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research Incorporated, a registered broker-dealer. Member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and Private Financial Design LLC are not affiliated.
Bread and butter.
Welcome back, everybody. We're going to be looking at how do we get that money out. I mean, you've got your last career, your second longest career you're probably ever going to have is retirement. So we want to make sure you know how to get your money. You saved and you've planned, and now it's time to pay yourself. So how does money move into your checking account? How do taxes and Medicare fit in? And can you plan an adaptation as life changes? Can you make sure that you have flexibility with all of that income need? And how does your spouse or partner fit into this plan?
Yeah, I think the central theme around today's podcast is going to be retirement is a shift in mindset. Like you just alluded to, you've planned, you've saved your whole life. Retirement, now you're spending down that money. Your regular paycheck is maybe stopped. So how do you replace that? Where do your different sources of income come from? And how do you actually generate a maybe stream of income that fits you and your needs in retirement now that this whole kind of a situation is changing and you're not having that W-2 wage?
It's a whole lifestyle change. I mean, you've worked in your career for 30, 35, 40 years maybe, and you've always collected this paycheck. Now it's time to pay yourself and how you do that. So let's launch right into it.
There's a lot of different sources where that income is going to potentially come from. For a lot of people, there's going to be Social Security. Not for everyone if you didn't pay enough into it, but a lot of people, especially with the new rules, now qualify. If you're married, you may also qualify as well too, even if you don't for your own record. And so Social Security is going to be one stream that's very similar maybe to a paycheck. You're going to get that check every single month.
Yep.
Others is going to be pensions. So another similar kind of automatic monthly amount. If you're lucky enough to still have a pension, or you work for a state organization or government organization that has one, you may also have this pension stream of income. And then we're going to talk also more about some of the more flexible assets, your personal things, your retirement accounts, your regular non-qualified investment accounts, and then other ancillary things like maybe some annuities, and maybe even investment real estate or part-time work, other sources outside of the maybe the traditional things that can also generate some income in retirement.
And as we move on here, for all of you out there that you might be in a state like Massachusetts where you got a state pension and you never were able to collect Social Security. Well, now you can. So that law passed and that provision's available. So if you have a spouse that worked in state government and you never did, and you have this Social Security income coming in, your spouse can apply for it and get up to half of your Social Security benefits. So if you're out there, make sure you take advantage of that new spendthrift position.
Yeah, it's a big deal because it's making spouses eligible for some benefits that maybe they weren't in the past. So
exactly.
It's adding potentially hundreds or even thousands of dollars per month to some retirees' income sources, which is a big deal. But when you do sign up for Social Security, whether it's your own or whether it's your spouse's, it can be a pretty simple process. You apply for it either online, you can call the Social Security office, do it over the phone, or even go in person if you have a local one nearby where you live. Apply for that Social Security benefit to start. You pick the date and everything. And usually we'll recommend people starting a few months in advance, at least. Social Security is a little slow on the uptake here with some of their applications.
3 to 6 months.
Yes, it very well can be in some cases. And so you want to make sure your application is in well ahead of time. Now, even if there's some delay, you'll get your money. It's just going to be delayed. You'll get any back pay that you might have missed. But you can have it direct deposited right into your bank account. You can have it pay your Medicare premiums too, come right out of that check.
And this is really, really key because there are people that they like, well, I'm not really going to use my Social Security. I want to just save it. Okay, we'll put it into an account where it's going to go and get saved. That's fine. For most people out there, they want to use it for their living expenses, which is great. So make sure you put it into an account that you have easy access to, doesn't cost a lot of money. And then at the same time, you're right, you want to get those Medicare premiums deducted automatically from your Social Security payments if you are at that eligible age for it, as well as federal and state withholding tax options. Let's talk about that.
Yeah, because I think some people think Social Security is not taxable.
Ah.
It might not be. It might not be.
Right.
But it might. It all depends on your income, how much you make, and other sources too. And it also depends on what state you live in. If you're lucky enough to live here in Massachusetts, Massachusetts does not tax Social Security.
Correct.
And if you're low enough on the federal income side, well, you might also pay no federal tax. But there's plenty of scenarios where if you've got some other income coming in, you do some part-time work, maybe you've got some money coming from a 401k or any number of things, you very well could have to pay some tax.
One little caveat to that I want to throw out there, and you'll know it, you'll recognize it, is that even if you weren't owing any federal tax on it, it might be beneficial to have federal income tax withheld from your Social Security payment rather than withholding it from your IRA. Why? Well, if your pension's coming in or your Social Security's coming in, you can have those taxes withheld whether or not you're going to be taxed on that particular income or not. Because if you have money coming in from your IRA, if you want a net income from that IRA, you're going to have to take out more to get it out after tax. So rather than taking it out of your wealth, take it out of your steady income, take it out of there, and don't take it out of your IRA. That's a planning situation, but it's just a good way to leave assets invested because your Social Security monies, it might grow maybe 2 or 3% per year based on the inflationary pressures that they put on it. But your assets could be growing at a much higher amount.
They could. And so that's, back to that, we've mentioned it in other episodes, opportunity cost, type of scenario, leaving that money invested and letting it continue to work. Now, another stream of income, very similar to, at least in structure, to Social Security, could be a pension. Again, if you're lucky enough to have one. So we've mentioned at the beginning, if you're a state employee, government employee, or you work for a company there are still some private companies out there that have them, although they're very few and far between these days. But they work very similar to your Social Security setup. You apply when you're eligible. Every pension's got some different rules. So it could be 60 with 10 years of service. It could be age 65. It could be all sorts of different age and years requirements where you can begin that pension. So you want to make sure you're looking with, your pension administrator, your HR rep, and making sure you're understanding your eligibility.
Make sure you have that person's name.
Yes.
And if they retire or they move on, make sure you find out that next contact person. I can't say how many times people have an issue with trying to change their bank account or other things. And again, you're going to want to choose the right bank account for this. If you're going to be using it, put it into the checking account of your choice, or if you're not going to use it, put it into a savings account or another investment. But automatically have those federal and state tax withholdings held from your pay. Most pensions are going to be both federal and state taxable, except in Massachusetts if you have a pension coming from the state government, which is not state taxable.
Right. And there are a few other states out there that,
there are some,
that don't tax retirement assets. I think Illinois is another one just off the top of my head. But, you want to make sure you're withholding appropriate to your state and federal situation. And then the nice thing about these sorts of income, pension and Social Security alike, is the predictability.
Yes.
You're getting a nice fixed income stream. So
it's coming. It's a foundation. It's a core of what you're going to be living off of. So
right. Now, while that predictability is nice, there's also some downsides to it too. It's going to be that amount, whether you need more or less.
Right.
So there's no more dipping into it if you have a big medical expense.
And most pensions are not inflation adjusted. Whereas Social Security does have.
There's a couple that are, but you're right. Most
are
not, because it's a very expensive provision for pensions to add.
Exactly.
So it's important to have some of these flexible ones too.
Yeah. So now we've got our personal assets such as like a traditional IRA. Now, the nice thing about a traditional IRA is it's fairly flexible as to the amount that you take out. Now, again, you got to do some planning here. Some people, they don't take anything out of their IRAs until they're absolutely required to do it at age 73 or maybe age 74, depending on what year you're born. But when you do that, now you're faced with a very large required minimum distribution that you may not want it to be so high when you're at that stage. So a lot of times we sit down with our clients and we plan out a strategy so that they're not surprised when they're having to take out their RMDs, the required minimum distributions, and they're not going to get whacked daddy with a bunch of taxes. So it's a very flexible way to do it, unlike a 401k, which has a mandatory 20% federal withholding.
Right. So if you're, and we see this with people all the time, if you're looking for some of that extra flexibility after you retire, when you're no longer contributing to your 401k and neither is your employer, well, a lot of times the most common route is people will roll that over to an IRA where you will get that additional flexibility. You can be more flexible with the taxation and you can easily set up your IRA. And I feel like this is a super common question we get all the time is, well, how do you get money from your IRA? Well, if you just want to set up a monthly distribution to come from it, or quarterly, or even annually, but I think for a lot of people, monthly or maybe even twice a month is a lot more similar to the way they were getting paid when they were working still.
Exactly.
So you keep that consistency, you keep the kind of comfortability with that structure, and you could set that up with your IRAs. You could set it up that way with some 401ks, but like we were just talking about, many 401ks are much more restrictive.
And then with the 401ks, you don't have the flexibility a lot of times in payment. And we really recommend for people to put it into their own IRA so that they have the flexibility, not having to pay that 20% federal tax and then get a bunch of money back on a refund.
Right.
Now, your Roth IRAs fit into this too. And all of these, you're going to set up your own checking account for this money to go into. But Roth IRAs, those are tax-free withdrawals. If done properly and done right, those Roth distributions are all going to be tax-free, and they fit in a planned portfolio. Now, the next one is a tough one because if you've inherited money from your mom or your dad or a child or a sibling or even just a friend, I mean, a beneficiary IRA, you've got special rules that apply to you based on when that ownership took place as a beneficiary IRA. There's too many rules for us to go through in this particular episode, but you got to have taxes withheld from that. It's all going to be taxable to you as a beneficiary regular IRA. If it's a beneficiary Roth IRA, well, again, that's a 10-year rule in most instances where you have to take the money out, but it's all going to be tax-free. And again, make sure you have the account of your choice for where you want that money going. That is that's your paycheck.
So I think maybe the overarching theme that I'll add to all these options is the flexibility factor. Being able to kind of control where some of this money's coming from, being able to control how much and when, being able to also control what types of investments you're selling as this money's coming out. Does the portfolio get reallocated at times to be either more risky or less risky, depending on how the market's doing at that time? And then the big one, being able to control taxation too, and make sure that your tax situation is as efficient and low cost as possible, as you're navigating your income streams in retirement.
Now, when we get into the next side of this, it's like you're looking at other personal assets that are a little bit different than what we would call qualified money. Now, qualified money is money that you've even been given a tax deduction for by contributing to it, and it comes off of your income tax. Or it could be a Roth IRA where it's qualified in the sense that you pay tax on it going in, but you don't pay tax on going it out. The next one we're talking about are really basically non-qualified investments where there's been no tax deduction. Most of what you're going to pay for taxation on some of these is going to be really capital gains, short-term, long-term. There could be income tax in it. But if you own a trust or you are a beneficiary of trust, you got to know those rules. Like if your grandparents set up a trust for you and it's still ongoing, or your parents set up a trust for you, or you've set up your own trust, There's all kinds of grantor retained income trust and other things like that you have to really know the rules as to how much is income and how much is principal, which is be tax-free. Your savings and brokerage accounts, where your investments are, again, this is mostly capital gains with some income that comes from it. And if you're using municipal bonds, which is a whole other conversation, some of that income could be tax-free.
Again, kind of I think the overarching theme with these accounts is, well, you're getting some flexibility, just like with the retirement accounts, but you're often with these getting even a little more flexibility, to your point, on the taxation. So these can kind of be good, some of these accounts, like your regular investment accounts and even in trust accounts too, well, they could be great sources as kind of your emergency fund. If you have a big expense that comes up, you need to replace the roof all of a sudden, a big medical expense, something goes in your home, whatever it might be. Well, this could be a good source because of the maybe more efficient taxation to, if you need an extra 20 grand in a year in retirement. Well, you're getting your regular income from your pension and Social Security. Maybe you're getting another regular stream of income from your IRAs and 401ks. Well, this is the bucket you dip into as kind of the emergency money of, I need an extra 20 grand for this big expense. It's a perfect source.
And your taxes on these kind of accounts really depend on the structure of the asset and the type of vehicle that it's in and however the rules are around it. I will say this, a lot of times people get surprised when we say, yeah, you get a large capital gain, but you can actually take that money, even though it's not an IRA or 401k, you can actually send money on that transaction to the IRS. Or to your state government if you wanted to do that. You can have taxes withheld from it if you choose to, or you can wait till you file for the next year.
You can. So as we kind of break down the differences between these different types of accounts, the qualifieds, your retirement accounts versus some of the more non-qualified structured or assets and their structure, is looking, as we've already kind of discussed, income either maybe being fully taxable or partially, so you get some of that extra taxation there, or more efficient taxation, I should say. And then non-qualified assets, being able to strategize when pulling money from them, because some of those assets may use a, either a LIFO or a FIFO tax treatment. A lot of them being that LIFO side, which that acronym stands for last in, first out. So you may be looking at pulling, from those sorts of assets that are non-qualified, the earnings first. That's what that last in, first out means. Your earnings is usually the last money that's made it into the account. So when you make a withdrawal, that money comes out first.
So for those of you out there that have an annuity that's not an IRA or not part of some retirement plan, it's just a non-qualified annuity, you put 100 grand into it and now it's worth 200,000. When you take that out, it's the LIFO. It's last in, first out. So they're going to look at the interest first, and they're going to figure out a formula as to how much is the basis and how much of that money coming out is tax-free because it's your original principal, and how much of it is interest from the gain that has happened in that time frame. But just remember, with annuities, there's no long-term gain. There's no short-term gain. It's all income taxable that is income taxable. The principal isn't taxed. So if you're getting a $1,000 a month payment from that $100,000, it could be that 500 of it is income taxable and 500 of it is principal tax-free. But it is never a long-term capital gain or a short-term capital gain coming from that. On that note, if you do have an annuity, we hardly ever recommend, but we do on occasion recommend that someone does not annuitize their annuity. The moment you annuitize an annuity, the principal is gone. Now, there are reasons to do it, and that is because you've created your own pension and you want a steady income at a fixed number for a fixed number of years. That's fine. But once you annuitize an annuity, it's locked. It's the insurance company owns it, and they're going to give you a distribution based on the arrangement that they've made. So be careful when you are looking at annuitizing an annuity, realizing that you are not able to get that lump sum back out again.
And then for those of you out there that may have some of the more maybe unique streams of income, because the ones we touched on so far are maybe the most common, we could also be looking at incorporating properties into your retirement scenario and generating some income. It could be as basic as you've owned some rental properties and you're getting some rent, maybe just like you were before you retired, and that check comes, once a month at the end of the month, and it's part of your overall income. It could be just as easy as that. Well, it could also be that if you're lucky enough to, own a commercial property, well, maybe there's some leasing income, and that could be a little trickier because is it leased or is your property rented, 24/7? Are there some months where you need to float the, costs of operating those properties versus not? So you want to be able to build that into your retirement picture. And then lastly, are you using maybe even any of the equity within your properties as well too, whether it's loaning against some of that equity or whether it's even, even though not super fond of them, they have some scenarios where they could make sense, even things like reverse mortgages in some cases, in extreme scenarios. But these are all different potential avenues of income that you could be getting from these different properties.
Yeah, and just remember too that when you hear people talk about, particularly if you're younger, and you hear people talking about, oh yeah, I've got all this property and I'm collecting income on it, or that's my plan and all that. Well, what I've experienced over the years, it can be a brilliant idea, particularly if it's done well and you're able to have a really good set of hands and do a lot of your own work. That helps a lot. But for the most part, as people age, unless they have a property manager, I've watched over the years, a lot of my clients, as they get older, they can't keep up with the properties. Yes. And now they have these huge capital gains that they can't hide anymore because they've had it for a zillion years and there's no depreciation left. So they're going to sell it and they're going to pay all this long-term capital gain. Not a bad thing necessarily, but you got to remember, if you're doing something like this, make sure your bookkeeping is tight and understand your ownership rights and the distribution rules based on how you own that property.
Absolutely. So as we kind of begin to wrap up here today, there's a lot of different income sources, as you can see. There's multiple income sources from many different places: Social Security, retirement assets, regular investments, cash even, or other things that we maybe even haven't touched on too much today, like it could be maybe some part-time work or other sources along those lines too. And so the idea here is I want to make sure these things are all coordinated.
Yes.
And working together. You want to make sure that your taxes are planned for, you're withdrawing carefully, because there's lots of implications from withdrawing from the wrong account at the wrong time. It could be higher taxes in a larger tax bracket. It could be another one we often plan on with our clients is IRMA brackets that cause you to pay higher premiums on your Medicare, costs and things of that nature.
That's a big one.
So there's lots of different reasons to be efficient with your retirement distributions to make sure your taxes are as low cost as possible.
And flexibility is the key in retirement. You want to be able to have the flexibility with your assets to withhold over here or to spend this over here and have access to that money. And a clear system keeps your income predictable and keeps it sustainable. We're really glad that you listened to us today. Just remember these few items that are so key. Number one, income comes from multiple coordinated sources.
Number two, Social Security and pensions will help give you that baseline, that nice stable stream of income.
IRAs, 401ks, and your brokerage accounts, they fill a gap, and they're important.
And then taxes, Medicare premiums, you need to be planned for to stay efficient and low cost.
And the best way to take them out should fit according to your plan. Remember, flexibility matters as your life and the markets change.
And make sure you incorporate any benefits that you might have from your spouse, or incorporate, money for your beneficiaries too, if that's something you value or a goal of yours, as part of your overall retirement.
Well, we hope this helped you today. Everybody really needs to understand that there's a way to pay yourself in retirement. We're really glad you joined us today. So remember, live today for the tomorrow that's in your heart.
Because you'll never have more time to plan for tomorrow than you do today.
Thank you for listening.
Butter.